In this video, I want to talk about the use of leverage, specifically how I use leverage in my investment portfolio. Key phrase there, my investment portfolio. This is not a video on how to use leverage. I'm not suggesting you should use leverage. I'm not recommending that you use leverage in your portfolio. Absolutely not. Leverage can be a very dangerous animal if not used responsibly. So please, before you even try anything that I'm even suggesting I use in this video, please seek professional financial advice before launching into any kind of such investment. So, if you are new to this channel, my name is Jared Ayers. I am a CFA charter holder. I created this channel to share my tips, strategies, tricks, tactics that I use on a regular basis to outperform the market. That's really the purpose. Like this video today, I don't always follow the mainstream tactics or strategies that maybe are more popular in the financial and money management world. So let me introduce to you how I use and think about leverage in my own investment portfolio. Now, before we get into the specifics on how I use leverage in my portfolio, let's just quickly talk about what leverage is. Okay, so classic definition, using borrowed capital to effectively invest and expand the asset base of a portfolio in some manner. Okay, or simply speaking, it's basically a way of amplifying the potential returns in a portfolio. Now, obviously, when you're borrowing funds of any type, as much as you can amplify the upside, you can also amplify the downside because obviously you're using borrowed capital. So if something goes wrong with the investment, not only do you lose the investment, but you also have a debt that needs to be repaid as well. My own personal preference, I don't like that kind of leverage. It kind of doesn't really give me a warm and fuzzy feeling. I kind of know I want to know what my total loss potential is, so I prefer a form of leverage that really caps my downside, so I know exactly what my downside is, and doesn't force me to actually borrow anything, yet still allows me to amplify my returns in my portfolio. My preferred form of leverage is actually options. Options allow me to cap my downside, know exactly what my risk is, yet also allows me to amplify my upside. So, for those of you who are not extremely familiar with options, let me just recap what an option actually is. It's a contract. It's a contract that gives the option holder the option, not the obligation, to buy an underlying security or instrument at some predefined price, known as the strike price, at some date in the future, known as the option expiration date. Options, like I said, are a vehicle that lets me know exactly what my downside is. That's the option premium. That's the price I'm paying for the option. I can only lose that amount. I can't lose any more, so I know exactly what I'm getting. Myself personally, I prefer to invest in LEAPs, or long-term equity appreciation securities. They're basically options that have an expiry that is greater than 6 months from the point of purchase. So usually 6 months to 3 years in terms of expiration duration. They cost a lot more, but personally I like to give as much time as possible for the underlying security to do what I think it's going to before I have to actually go ahead and execute on that transaction. In terms of how options are priced, there are three really basic elements to what determines the value of an option, without going into all of the complicated options pricing models and things that you may have heard about. So the three things are the intrinsic value, they are the volatility value, and then there is the time value. So the intrinsic value is effectively the strike price relative to the current spot price of the underlying security. So in other words, if you have an option to buy a stock, that would be called a call option, and the strike price is, say, $20, and the actual underlying security is $30, then you have an intrinsic value of $10, which is the difference between the option strike price and the actual spot price of the underlying security. So that is a very easy thing to calculate. And the example I just showed is an option that's actually in the money. You could have, of course, the opposite, where the strike price on a call option is far greater than the underlying security, and therefore the money or the option would be known as out of the money. So there would actually be no intrinsic value. So although the option would still have a price, the remaining value of that option is the other two elements, the time and the volatility value. And how I think about those is really, I just split them evenly between those two, because I don't really worry about the actual calculation on time value versus volatility value. The longer that the option has before it expires, it's going to be more valuable from a time basis. And also, if the underlying security is quite volatile, that also creates a higher priced option, because the range in which that security can move may mean that that option becomes in the money more often than if it's if it's an out of the money option and there's very little movement in the underlying security. So a lot of explanation there, but basically, I'm looking for and measuring the intrinsic value of the option, and I usually have an actual strategy or a thought process as to what I believe between now and whatever the expiration date is, the underlying security will be worth, and therefore obviously I would believe that at some point in the time when I own the option, it's going to be in the money significantly enough such that it is worth many times the premium that I would have paid for the option. So that's just a little bit of background on how options work and how they're priced. So now we'll just jump into how I think about options and when I might consider using them. In terms of times when I think about using options, there's really three main scenarios when I consider using them. The first is when there's a market correction. So none of my indicators are going to tell me when an actual correction occurs. They're going to tell me when an actual change in the business cycle and the economic environment is actually going to change. So corrections happen fairly frequently, and as long as the economic indicators are telling me that things are still strong, that's a good time in my mind to go long on options if you want to take advantage of dips in the market. The second scenario will be when I want to add fuel potentially to a very liquid large cap position. So maybe there's a high conviction name that I've purchased maybe at a fairly decent discount. It's not growing necessarily, or doesn't grow, won't grow at a very significant pace, but it's still a really solid high return on equity, all those variables that I look for in stocks, but I want to add a bit of fuel to it. Options are another way of doing that, alongside the actual ownership of the security. And the last situation is more defensive. So if I have, if my economic indicators are telling me that things may be getting a bit rough, but I'm looking at my positions and there's nothing really that I can see that is telling me I need to be selling anything, sometimes what I'll do is, rather than selling, I can put on what's known as a protective put, or an option to sell at a predetermined price. And again, you can do that not necessarily at the individual security level, but you can do that across ETFs, some of the very index, broad index related ETFs like SPY, which is basically the S&P 500 ETF. Tons of options available, very, very liquid, and just gives you sort of a total market exposure and protection if you're going to buy a put option against that ETF. So those are really the situations that I think about using options during. There are a few things you want to consider with options, or things that obviously I think about all the time. Number one is they're priced as an individual contract, but to buy one, you got to actually buy 100, lots of 100. So whatever the price of a certain option is, you got to add a couple zeros to that, and that's actually the price you would pay for one effectively option contract. The other things that you do want to consider with options are you want to have certain rules around when to sell them. they will expire worthless if they're out of the money. So if you want to have or retain any value in an option, you do want to have specific rules around when to sell. So for myself, I told you that I like to invest in leaps. So I like to sell leaps when they're still leaps, because under 6 months, when the expiry falls under 6 months, the volatility in the options pricing can be a little bit crazy. It can sort of go against whatever the intrinsic value of the option is as it gets closer and closer to expiry. So I just like to stay out of that altogether. So those are things you may want to think about if you're ever considering using this type of leverage. Obviously, I think about it all the time. And also, you want to think about position sizing. So again, if it's out of the money, or if it potentially could go out of the money, which any option has the potential to do, then you do want to think about when is it, or how much do I want to invest. For me, it's a very, very small percentage of my total portfolio. I want to really, really limit my downside, and so I do that by investing very, very small amounts. Upside can be very significant, so that's built in. I don't need to necessarily bet the farm on an option position. So just something to think about. And also liquidity. So it's important for me to look at options that are very, very liquid. So like I said, either they are based on very widely traded ETFs that track big, broad markets, or maybe Fortune 500 companies that are very, very liquidly, or have very good liquidity and are traded in very, very large volumes. The options against those stocks are generally quite plentiful, and even if you're just buying a handful of options, it's easy to get out of a position if you need to. So again, those are just the thoughts that come across my mind when I'm thinking about investing in options as a form of leverage in my portfolio. So I hope you found that video useful, a little bit of information on how I use leverage in my own investment portfolio. Again, this is not a recommendation, this is not a suggestion. Please consult a qualified financial professional before you even ever think about using this or any other type of leverage in your portfolio. It can be extremely dangerous if not used responsibly, so please be sure you do that. If you want to add a comment, tell me what you use in terms of how you add leverage to your investment portfolio. I'd love to hear about it. If you have any comments or questions about anything you heard in this video, please share them in the comment section as well. If you're new to this channel, you want to see some similar topics, then please always click the subscribe button if you haven't already, and of course leave any comments about what you want to see in the future in the comment section as well. So until next time, thank you very much for watching.